In other words, just going through January and the first few days of February, we've had an acceleration in the rate of stand for deliveries of gold. And that, I think, probably helps explain where the panic is. The end of December, the last 4 years, over 2,000 tons of gold stood for delivery. The question is, how much of that has actually been delivered? Now, the experience of Sprott trying to get hold of its silver rather suggests that there is a hell of a backlog of physical which is being stood for delivery. Now, let's sort of, it has accelerated in the last, in this year. This year so far, it's been running at a rate of over 2,200 tons for this year. This is, if the current level. This acceleration, I think, is probably the straw that is breaking the camel's back, as it were.
Since early January and into February, there has been a noticeable acceleration in the rate of gold standing for delivery. Over the past 4 years, more than 2,000 tons of gold were marked for delivery by the end of December, raising concerns about how much has been fulfilled. Sprott's challenges in acquiring silver suggest a significant backlog in physical metal deliveries. So far this year, the rate has surged to over 2,200 tons, and if this trend continues, it could be the breaking point for the market. Alasdair Macleod, a renowned economist, financial analyst, and expert in precious metals, explains that many futures traders have likely taken delivery of their gold through the global facility, particularly foreign holders with gold stored in COMEX warehouses. Concerns over Trump's election, the future of the dollar, and distrust of U.S. policies, especially among nations like China, Russia, and BRICS members, have driven a rush for physical possession. This has led to a surge in gold shipments from London, depleting the bullion market and creating a backlog at the Bank of England, where withdrawals now face delays of 4 to 8 weeks. Alasdair exposes that the shortage of physical gold has become evident, with even bonded warehouse reserves in India being redirected back into COMEX. This signals a severe supply crunch, exacerbated by the rapid acceleration of gold standing for delivery in early 2024. While gold can typically be moved quickly, logistical bottlenecks, particularly at key institutions like the Bank of England, add to the market panic. Don't forget to subscribe and hit the bell icon to stay updated on our latest videos. We'd love to hear your thoughts in the comments.
Have actually taken out their futures positions and have stood for delivery against those through the Globex facility, which, if you like, is the 24-hour facility outside, outside New York. So you've got all these foreigners who've got this stuff stuck in a COMEX warehouse. And they are now agitating to get their stuff out. Why? Because Trump has been elected. They are very concerned about Trump. They're concerned about the future of the dollar. They want physical possession. I mean, the Americans, I mean this most sincerely, as it were, the Americans are not to be trusted as far as the foreigners are concerned. We've had in the past gold confiscation. You just don't trust anything that the Americans say, particularly if you're Chinese, if you're Russian, if you're, in the global south, BRICS, and so on and so forth, which I would guess quite a lot of these stands for delivery are. So I think that's what's happened. We've got a panic, and this is why they're flying in huge quantities of gold from London, and they've tapped out the London bullion market. And so much so that there is now a 4 to 8 week queue at the Bank of England to withdraw presumably leased gold from the Bank of England. So you can see that there's a real panic on here. And then this morning, Reuters reported, or it might have been overnight, reported that gold has actually been coming out of bonds, as it were, the customs houses in India. Now, this is gold which has not, if you like, cleared through into the domestic market. What happens is that the big consumers of gold will buy bullion, store it, as it were, in a bonded warehouse, under the sort of customs arrangements, not paying tax on it until they have to, when they then import it into the domestic market. Even they, apparently, have been sending gold back into COMEX. So you can see that there's a huge shortage of physical gold, presumably because these stands for delivery are now coming home to roost. And that roughly, I think, is where we are. Of course, the other thing to bear in mind is that while the crisis, I think, is in gold, very, very definitely, if you look at the way it's accelerated, the stands for delivery have accelerated in the first month and 2 days of this year. You can see why that's triggered an enormous panic. But gold you can move relatively quickly. That is assuming that you can get it out of the warehouse, which is the other problem. As I said, the Bank of England is taking 4 to 8 weeks, according to the Financial Times.
Alasdair discusses a growing realization, especially in the global south, that physical possession of gold is crucial. This awareness was heightened when the US and NATO froze Russia's bank reserves, signaling to other nations the risks of holding assets in Western financial systems. At the 2022 St. Petersburg Economic Forum, Putin strongly urged countries to move away from dollars, euros, and Western-stored gold, a message that has since gained traction. As a result, major buyers like central banks and sovereign wealth funds are securing gold before it even reaches the market, limiting fresh supply and tightening availability. Alasdair suggests that this supply squeeze and rising demand have driven gold prices higher, with spot prices currently at $2,840. Meanwhile, futures and credit markets appear unprepared for the rapid gold price surge, as evidenced by falling open interest in COMEX contracts despite rising prices. This unusual dynamic suggests a more profound structural shift in the gold market than speculative positioning. The notion that gold is due for a technical pullback may not hold, as the forces driving this rally seem more fundamental and systemic. Now, let's get back to the interview.
And I think where we are is that there is a broadening realization that possession actually is very important. I think as far as the global south was concerned, the first inkling that this was actually very important came from when the American NATO attempt to cut off Russia from Western financial markets by stealing, and there's no other word for it, and I don't apologize for using this word, by stealing Russia's bank reserves, alerted everybody to this. And in the St. Petersburg Economic Forum of 2022, this was something that Putin, majored on in his speech. And that was attended, I think, by over 80 nations. And something like 14,000 representatives or something. I mean, this was a very well attended event, and the message was absolutely clear. And he said, you don't want to hold dollars, you don't want to hold euros, and if you've got any gold stored in the Western vaults, then get it out. So, and I think that message is trickling down. And of course, the problem, I think, in, sort of, if you like, in bullion markets generally, is that the really big boys, central banks and sovereign wealth funds and all the rest of it, are preempting gold before it even gets to the market. So the market is kept short of fresh supplies. The only stuff that really comes into the market, I guess, is sort of from friendly sources. But I mean, China's out, Russia's out, various other nations, I think, in the middle of Asia are also out. So you've probably got about, almost half the world's gold mine output not reaching the markets at all. And as for the rest, I mean, what do you do? I mean, if you're really looking to pick up decent slugs of bullion, I think what you do is you just get into the queue at the refiners. I'd say, let me have what you can when you can. And I think that's basically, it's happening to a greater and greater extent. And of course, it's driven the spot price up. I mean, as we speak today, we're looking at 2,840. And you've then got this problem on the top that the credit markets, by which I mean forwards and futures, over the counter and regulated futures, those are pure credit markets, and they haven't, the bullion banks and all the rest of it haven't actually got their ducks in a row for such a move in gold. Interestingly, I think it was yesterday, there was actually on a rise in the price of gold, the dollar price of gold. There's actually a fall in the number of outstanding contracts on COMEX. In other words, it was rising despite what we would normally regard as managed money and other bulls liquidating their positions. So this is actually, I think it is actually quite a serious move. And I think the point I would like to make is that the idea that you can sort of say, well, it's moved so far and it's bound to get a reaction and all the rest of it, and all that reasonable sort of analysis, I think counts for absolutely naught.
In light of these developments, the accelerating demand for physical gold, coupled with logistical constraints and geopolitical uncertainty, suggests a fundamental shift in the market. As central banks and investors scramble for secure holdings, the strain on supply chains and futures markets could intensify, potentially reshaping global financial dynamics in the months ahead. How might central banks and institutional investors respond to the ongoing physical gold shortage? Could the current surge in gold demand signal a more significant move away from the US dollar in global trade? Share your feedback in the comments below. If you found this helpful video, hit the thumbs up and subscribe to keep up with our latest updates. We appreciate you being a part of this journey.